Okay, welcome back to our channel, MegaWhale team. Thanks for tuning into today's video. We have a lot to talk about today, guys. We're going to go over a heap of stuff. If you're interested to find out everything from market analysis, technical analysis, where the macro bottom is going to be, CPI, economic position, all this cool stuff, stick around to the end of the video to find out absolutely everything we can show you when it comes to the market. Now, before we get started, I do want to draw your attention to a pinned comment down below. Go ahead and click the link to our Telegram channel. Get access to all of our videos in here, daily market updates, educational stuff, and much, much more. Let's go ahead and dive right into the video. So, Bitcoin over here, guys, it is at a position I would like to call, and I've been calling, the last line of support. Now, the reason I call it the last line of support, because this is the biggest and most significant support zone. And I'm talking about zone, not a support line, support zone on the chart for Bitcoin that we have, okay? This zone between 17,500 and 19,200 not only is the largest in terms of percentage width, but it is also the most significant in terms of price positioning on the chart. And the reason is because it meets up with this golden zone or this 9-year trend line we've had on Bitcoin that's marked the absolute bottom on 2 other occasions in the last 2 bear markets. And that is why this last line of support is in fact the most crucial and critical level at the moment on Bitcoin, and a level that we need to be paying very close attention to. Now, I'm going to go ahead and just rewind a little bit on the chart over here. What we can see forming, unfortunately, is a bearish ascending wedge formation, or what you would call a rising wedge. Now, of course, we have the CPI numbers coming out soon, and we're going to talk all about that, but we're going to focus more on, this right now. So obviously a rising wedge, guys, is a bearish pattern. And we've talked a lot in the last few days about a significant down move. All the way, we're talking about it up over here when we had this pennant formation 2 days ago, guys. We told you, all the way up over here, that if we broke down from this pennant formation we developed on the short-term time frame, we were going to head down to 20,900, and if we broke that, we're going to head down to the support line. We have seen that move. That was a very significant move for Bitcoin, an 8% down draw that we saw, and we predicted perfectly. Now what's happening is we're reaching the bottom of this new formation, which is actually a rising wedge, and we had confirmation of that from that last close up over here, making it a higher high, lower lows forming on this uptrend. So we have this rising wedge formation. We are now at the bottom. The question is, are we going to see another move upwards on the short term? Or are we just going to flip straight down? And we're going to come back and kind of answer that throughout the entirety of the video. More specifically at the end of the video when we do our technical analysis. It's not something I can just give you a straight answer for. We have to kind of analyze that one together. But we haven't done that yet. But what I can say for sure is right now we're reaching support. There is a possibility here that we find a little bit of sideways action or potentially even a bounce back upwards. And I think we'll see a bounce up to that 200 moving average, which will sit us around 20,500 be a good target for a short-term bounce if it does occur. I don't think we're going to rally all the way back up to the top of the wedge. I think it's quite unlikely considering CPI numbers come out very soon. That's most likely going to throw some volatility, some instability at the market, and see as the prices kind of crumble a little bit temporarily, like they always do when the CPI numbers come out. Even if it's good news, most likely we're going to see a little bit of a drawdown and then a pump up. Economic news is very dangerous to trade into. I don't recommend trading into economic news. Just kind of wait it out and jump on the bandwagon when it's all done. So let's go ahead and talk about, what would happen if we do lose this trend line, because obviously the support line, the support zone we've talked about a lot, is a very critical bounce point. And we've used that Brave New Coin Liquid Index, that large macro log scale to kind of prove how that is over the last few months. We've been talking about this, ever since November last year. We've been telling you, this is going to be the zone where we find support. This is that potential bottom. This is a zone we want to be paying attention to. Now that we've actually come down over here, and we have the CPI numbers out, the economy is still looking weak, what would actually happen if we lose this level? And we're going to zoom out to show you, because we've talked about this a lot on this channel already. We've given you the examples, but we're going to show you again. So if we do lose 19,200, remember, this is a support resistance zone. So if we lose 19,200, there's a very high chance we head to the bottom of this range, which is sitting around 17,500. Now, I've also spoken about this first initial red line, where we do expect a wick down to, or an initial crash down to, if we do lose 17,500. This could be the fake out that we would see before we rally back upwards. There is a chance we have some sort of move like that. That is still in the back of my mind, still a real possibility I'm thinking about. And that initial crash would come from the CPI numbers, obviously a bit of drawdown in the next few days, crash to 16,500, push back through this resistance zone, finding it as support, and then pumping back upwards. Real possibility. But Let's say, guys, the CPI numbers come out horribly. They come out bad, it's worse than we expected, nothing's shown any sign of improvement, and it's likely that's going to be the case, all right? The economy is not in a great position. Likely that is going to be the case. We're going to see asset prices, particularly risk asset prices, continue to fall, and we will see them drop down, and there's a very high chance that could occur. But at the same time, we don't know until the data comes out. That's why I've been really pushing to you guys right now. You want to wait until it happens, because we can't make that assumption right now. It'd be stupid to speculate on that when we don't have the data. What we do have the data for is that this is a major support. We can expect to find support, and we found support twice. Do not forget, we've found support on $18,000 2 times. The first one, we saw a 21% pump. The second time, we saw a 25% pump. These aren't small amounts. 21%, 25%, these are significant moves for Bitcoin. Although it doesn't seem like much in comparison to a drop, a 25% move, guys, is still a lot of percentage move upwards. It's still a big percentage. So we're seeing significant pumps from these levels. Will we hold it again? Well, let's take a look. So if we do lose this level, guys, we will be heading down, 15,000, 14,000, 12,000 will be our target. Simple as that. 12,000 is our next point. Now, I do want to show you actually, let me go ahead and bring it up. I want to show you a chart that I posted a long time ago, guys. And this was this one over here, talking about 12,000's potential target. This is all the way back in April. We talked about 12,000, 13,000 being a potential target, because we had this bear flag formation, what I would call an ascending channel formation, actually not a bear flag, that we did break down from. I use a bear flag as an illustration. We've seen a significant pull down to that trigger point. We had our line in over here. You see 17,500, had that line in already, pushing down, and obviously we had that target down there. So there's a real possibility that this measured move will still be completed, and of course that'll be exacerbated by the fact if the economic data is still negative. So there's that bearish scenario, guys. But let's talk about the bullish scenario, and then talk about why economic information actually matters in terms of risk assets, how it actually plays a role in dictating price, how that plays a role in influencing price, and then why should you actually care. And then we'll talk about the CPI, of course, and then we'll go into the short-term analysis for Bitcoin, and in terms of macro, in terms of market analysis, and we'll go back to the technicals. So let's take a look, guys. Let's take a look. The short-term upswing would be what we would need to actually see to actually become bullish again. Well, we need a few things. We talked about this in the last video. We would need a move over the 200-day moving average. That is number one. So push over 200-day moving average, currently sitting at 22,700. Okay, and we would need a push over this downward trending dotted line. This downward trending dotted line, as you can see, has been a massive point of contention in terms of trend reversals and flips and supports and resistances on the Bitcoin chart, since all the way back in 2020, early 2020. We've seen a lot of supports on here, a lot of rejections, and obviously this has been a key point of resistance and support, once again proving that to us in this recent pump up into that range. We would need to flip this downtrend for us to have a move upwards, and the move upward would take us to the next red line, which is the next horizontal resistance, $28,000 will be that next level. Okay, simple as that. If we do flip 28,000, we would need to break out of this macro descending channel, the black line, and then push higher, reclaiming these resistance levels. All right, the more resistance levels we reclaim, the stronger the trend gets. And for us to flip a macro trend, we need to clear this level here. All right, the price gets above there. We're in a new bull market rally. We're on a new uptrend, a strong uptrend, and obviously that would result in a new all-time high for Bitcoin. Okay, let's talk about the economy, guys. And I'm going to quickly go up over here, and I think this is the wrong chart. This is another chart we'll come back to. I want to talk about this chart a little bit later on, but this is a visual representation of what we're about to talk about. So let's go ahead and go to the DXY, because the DXY is where we have that chart on. And obviously the DXY is pumping. We're at 108, and we did say 110 was a possibility, with a green line, which was representing the 11th, which is obviously also representing the 13th, which is when the CPI numbers coming out, because we are on that 7-day chart. But let's zoom out. Let's go to the 14-day, and we'll talk about the economy, because the DXY is a visual representation of cash flowing out of assets and into cash flowing out into assets is a representation of what's happening. So when the DXY decreases, we see a cash flow drawback into these assets, and obviously asset price rises. And when it rises, when DXY rises, we see asset prices fall. And we're going to talk about that in a second. But this is the current economic standpoint, guys. We've had rampant inflation over the last few months, and it's expected to increase even more. And the whole reason they're increasing interest rates is to try combat this rampant inflation. Everything's going up in price, and they're trying to combat that. So they're dropping inflation. They're hoping to drop inflation by increasing interest rates. Now, unfortunately, increasing interest rates has a massive snowball effect on the rest of the economy and economic decisions companies and individuals make, which also impact risk assets. And let me just go ahead and copy this, paste over real quickly. Cool. So interest rates rise. What does that do? Well, it increases debt on, increases interest on your debts obligations. So very, very simple stuff. You've got a home loan. If you're taking out a short-term loan, if you're taking out a long-term loan, whatever it is, if you're taking out a loan on interest, your interest repayments are going to increase, right? When interest rates rise, your repayments increase. And we've seen that already starting to happen. And we've been telling you guys and warning for like over a year now that, the housing market is going to be one of those bubbles that is going to pop because interest rates are going to rise to the point of which people can no longer afford to make their repayments. And then it's going to be this slow sell-off that's going to be exacerbated, and it's just going to crumble. And we're already seeing interest rates and mortgage repayments increase to astronomical levels in the US and happening here in Australia soon as well. So what's happening with that, guys? All right, we have two things. Household income, all right, household available cash decreases. And it decreases because the debt obligations increase and inflation increases. And if inflation increases, the cost of goods and assets, or cost of goods and services, increase in price. So available cash flow is decreasing while expenditure is increasing, right? Less savings. So that puts everyone in a risk-off environment. People aren't wanting to take a risk. They're not willing to, spend a lot of money. They need to conserve their money because their debt obligations increase, the debt to service ratios decrease. What does that result in? Well, one of the things is that retail investors look to sell their assets, right? And they want to sell it to cash, right? Because they need to increase their available cash to pay off their debt obligations, as well as to move into their cost of goods and services, food, or other services that are increasing in value, right? So that's one reason why asset prices have been falling. The next big one, and the real big one to why asset prices have been falling, is because of companies, governments as well included, selling off their balance sheets. They've taken massive amounts of debt during the times of low inflation, very low interest rates in the last few years, to accumulate income producing assets, whether it be property, whether it be shares, or it be cryptocurrency, whatever it may be. They've acquired a lot on debt. Now that interest rates are rising, their future cash flows are decreasing because the assets are requiring higher service ratios, meaning you have to pay more cash to keep those assets, to keep those obligations, those debt obligations, healthy, to pay off those debt obligations. And what does that do? Well, it decreases their cash flows. And if the company's cash flows decreases, their future earnings decrease. If their future earnings decrease, the stock price decreases. So we have this snowball effect where companies are now starting to increase or decrease, their holdings, sell off their assets from their balance sheet to increase their cash flows. And we've seen that happen, guys. And this is basically old news now. Everything I'm telling you is basically old news. All this stuff is very relevant, but it's already happening. It's happened. And we've been telling you guys for months. We've been telling you guys since last year that this was going to happen. And I had a lot of people tell me it's not going to happen. But guys, take a step back. If you understand the economic environment, if you understand how economic policy, how interest rates, inflation affects risk assets, affect assets in general, you would understand this is a very simple concept that you'd be able to wrap your head around. It was too obvious. It was too obvious. And I feel like because it was too obvious, people were just almost arrogant or ignorant to the fact that they believe it couldn't exist. You look at the housing market in Australia, there are people here that believe the housing market will not fall. They believe it won't drop in price, even though with everything going on, it's just ignorance and arrogance. I don't know if it's obliviousness or lack of education, but it's been so obvious, guys. It's already happening. It's already happening. It's already happening. How long will it go for? I don't know. I can't tell you how long it's going to go for, because the moment they decide, we're not going to pump interest rates anymore, everything should slowly come back. Money should flow back into risk assets. And I'm not talking about houses. I'm not talking about GDP. I'm not talking about economic growth. I'm talking about risk assets. These move faster. They react quicker. Obviously, the reason why America hasn't said, we're in a recession is because they're basing their recession indicators off much slower moving averages than what we see, what we see in the markets. So it's like taking a 400-day moving average and then taking a 100-day moving average and saying, oh, we've lost a 100-day moving average, but we're still above the 400-day moving average, therefore we're still bullish. All right, but in reality, you know, we're actually short-term bearish if we've dropped that 100-day moving average, but it's like neglecting that short-term data. So short-term data is still very relative when it comes to predicting market movements, because markets move very rapidly. So if you're interested in, you know, if you're currently trading the markets, or you've got money in the markets, your focus should be on these short-term moving averages, these short-term indicators, rather than these macro indicators that predict recessions and stuff. Because by the time they say, you know, we're in a recession, guess what? We've had a massive drawdown already. We've suffered massive losses. The markets have pulled back so much before they've even admitted we're in a recession. So it's very important to keep that in mind. Anyway, you're probably thinking, you know, all right, that makes sense. Let's go ahead and take a look at this chart over here. But you're probably thinking, you know, how does that affect Bitcoin? And we've talked a little bit about, you know, how it affects cryptocurrency and particularly risk assets. But you're thinking, you know, what the hell kind of relevance is this got anymore, MegaWhale? Why are we even learning this anymore? Because, you know, like you said, everything's already happened. You know, we're essentially late to the party when it comes to this. You know, we should have listened to you a long time ago. And for the new viewers here, it's like, it's not really too late, because there's still time to learn. You know, still information you can get. And this chart is basically a mathematical reflection of what we just talked about. So we have two types of risk, guys. And the main risk we're going to focus on today is systematic risk. And systematic risk is risk out of investors' control, such as interest rates, inflation, all right, monetary policies, all that kind of cool stuff that loves to ruin you when it's going the wrong way. But when it's going the right way, it can be a great tool for a trader to help increase the portfolio return while decreasing risk. So increasing systematic risk is what we've seen over the last few months. We've seen an increase in systematic risk. Now, when systematic risk increases, we see this line over here, which is a risk-free rate, decrease. If that happens, our beta increases because, all right, we see over here, the risk on the asset increases. Now, I'm not going to show you 100% accurate. It's not going to be 100% accurate here, but we can see something like this. We see how it gets moved across, gets moved this way. The risk of the asset increases while the return percentage potential remains the same. Now you can see there's a big difference between the stock and the cryptocurrency, stocks and cryptocurrency. All right, stocks generally have lower betas, okay, and lower risk-free rates than cryptocurrency. Cryptocurrency is generally a higher risk asset. What this chart is now showing you is if systematic risk decreases, all right, and goes the other way, so it's hard to grab all the lines. If it goes the other way, we will see a sharper rebound, okay, in cryptocurrency than we will in the stock market. All right, and the reason being is because although there was a 0.7 positive correlation between these assets, the return is still higher for crypto as the beta is still higher no matter what happens to the systematic risk. All right, so what this is saying is when the bounce does come, when the bottom is in, when it does bottom out, cryptocurrency will see faster and more aggressive returns than stocks. All right. On the other side, cryptocurrency generally also sees faster and more aggressive downswings than stocks. It's a more volatile asset, although it is tied positive 0.7, meaning that if the market is more positive, overall, we're talking the market, the economy, systematic risk, all of them. If it's more positive, they both increase. If it's more negative, they both decrease. What it doesn't tell you is how much, but it can tell you that crypto is more volatile, it has higher beta, it will increase and decrease in higher amounts. Anyway, I hope that gives you a little bit of an overview of what's happening in the market and a little bit of an understanding of the economic scenario. We obviously have the CPI numbers coming out soon. So what can we derive from this? All right, CPI numbers is a measurement, all right, of the effect of systematic risk in the economy, okay? Remember, it's a measurement of the effect of systematic risk in the economy. So CPI numbers are negative if they're poor, if they're worse than last month, we can assume that there's been a negative effect from the increase in systematic risk. Therefore, this will decrease. What happens when that decreases? The beta increases. What happens when the beta increases? The asset prices fall. There it is. Very, very simple, guys, okay? We can expect the asset prices to fall. And both stocks and cryptocurrency will increase their beta and they will both drop in value, okay? That is how this chart works. Simple as that. Let's go ahead and move on to the short term. I've been talking for 20 minutes now. Insane. If you're still here, thanks for stopping by. Obviously, it's great to have everyone here. I might take a short little break, grab some water, and then come back and get on the rest of the video, okay? Okay guys, we're going to be taking a quick look at Bitget, and now Bitget is where I personally trade. I highly recommend signing up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, could name a bunch more, KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up, well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Okay, I'm back. We're going to go ahead and get into the short-term market analysis next, and then we'll talk about the technical analysis and then wrap up the video. So market analysis wise, we're just going to talk about the structure over here. We have a very clear descending channel formation on the hourly forming, and obviously the descending channel formation is a bullish reversal pattern. It is a downward consolidation that results in an upward move once the downwards resistance has been broken. How can we take a measured move? Very simply, take it from the apex to the first initial low, apply that to the breakout point. Here is the target, assuming we break out over here. So we can say we can see a move back up to about 21,000. I don't think that's going to happen. The reason being is because although a measured move tells you where it can go, it doesn't tell you where it's going to find major resistance. We still have massive high volume ranges above us, and we can see a POC line is sitting at around 20,180, 20,200. That would be a major resistance zone that we can come across over here. So my target for the short-term upswing, if it does occur, would be a minimum of 20,065. We can see the high volume range starts to increase right over here, and that range of resistance can draw up between these levels over here, and potentially if it pushes past the POC, we can see a move back up to about 20,500 for an absolute high of that short-term move. So I'd be looking, if I was going to long, I'd be looking for an entry over here. I'd be putting my stop loss below this short-term up, or this long-term uptrending line, maybe around closer to around 19,600-ish, and then I'd be looking for initial take profits in here. I'd be adjusting my stop loss when I get to this point, and I'd leave the rest open to take initial or last profits at this level here. That's how I'd be trading that short-term. So there's my short-term analysis, guys. Real simple, real straightforward. Again, you're just using these macro patterns to identify points of contention on the chart. And I've had a lot of people ask me, how do I actually personally trade? And I use technicals to confirm my biases, confirm my directions, but I primarily actually trade or supports and resistances. I use support and resistance zones, particularly macro and short-term structures, and I trade structures. I've always found trading structures, you're not going to win every trade, but it's not about winning every trade. It's about consistently winning more than you lose. And structures, trading structures, you have generally a higher win rate than trading just purely technicals. So use technicals to confirm your structures, use technicals to confirm your structure breakouts, but trade the structures. That's what I do personally. Okay, if you want to find out more about that and you actually want to learn how to trade, just stick around to the end of the video. I have a short little snippet of the Crypto Academy course where I teach you all my technical analysis skills, all the things I use to use and find trades in the market and actually execute trades while teaching you everything about technical analysis and market analysis at the same time. Anyway, let's go ahead and do our technical analysis. Since we've been talking about TA so much now, let's get straight into it. So to start our TA, what we will do is we will go start on the larger time frame. So to do that, we'll obviously go to our large time frame chart, and this is our 7-day chart over here. Let's get rid of these green thumbs. I had them in my last video, maybe a video before that. Let's go ahead and bring up some TA indicators, and we'll start on the larger ones. The ones I'm not a huge fan of. Obviously, I've talked a lot about the bull market support band and why I think it's an utterly useless indicator on most time frames. Because all it's telling us right now, guys, is we're in a downtrend and we're under it, and that's it. So if you're trading up the bull market support band alone, you are really cutting your legs off in a sense that you're shooting yourself in the feet. You're not really giving yourself the best opportunity here to make money. Bull market support band is great, but it's good when we're getting close to it. You know, the time of relevance comes when we get into a bull market support band over here. These are relevant periods. Anything like this over here, it's all irrelevant really. It doesn't tell us too much besides the fact it's oversold or overbought. And obviously we can use other indicators to give us more accurate depictions of whether an asset is oversold or overbought and what to do compared to the bull market support band. So right now, bull market support band is not telling us too much. Not a huge fan of it, not telling us much, not really much talking about it. Now 200-day moving average is a big one. And I'm gonna go ahead and bring up the 200. And I'm also gonna go ahead and bring up the 300. Because the 300 is one that I wanted to talk about earlier in today's video, but I kind of actually forgot. It kind of slipped my mind, but let's talk about it now. Because the price is between the 200 and the 300. We don't see that often, all right? We saw it happen over here if we draw back the 300, and we saw it happen over here in March 2020 if we extend that out. But we're seeing it happen again, and we don't usually see it happen. The 300 has never been lost on the weekly chart. Not once has it ever been lost on the weekly chart. And that is currently sitting around 16,500. And that is why we said 16,500 is that potential bounce point for Bitcoin. If we do lose this trend line, we can potentially see a drop to that 300 moving average, to a 300 moving average before we bounce back upwards and continue upwards. It is a bounce point that we have to keep in mind. All right, moving on from there, guys. Obviously, 200 acting as major resistance still. Looking pretty bad. I'm not liking the look of this, guys. We're closing a lot of candles here on the weekly underneath the 200, and obviously the more we close under 200, the stronger that resistance is going to become for that 200. And obviously it's not an actual technical resistance zone, it is a moving average. It's not really a resistance, but it's indicative of a resistance. Okay, it's not a resistance, it's just representing a resistance. Big difference. So remember, moving averages, not resistance, they represent areas of resistance. But if we can clear that area of resistance, we'll make a move to the next actual resistance, which is in fact to $28,000 level. Okay, but so remember, the moving average is within this trend line. It's moving like a cross like that, something like that. All right, that's where it kind of is sitting right now. So let's go back to our chart. Let's go ahead and get rid of those. We don't really need those up anymore. Now MACD, I've had a lot of people ask me, you know, why don't you use the MACD as much on your videos? Sorry, my chest was a little sore. I went to the gym earlier today. Why don't you use the MACD on the videos as much as you used to, or like in general? I see a lot of people using the MACD. What do you think about it? And my opinion on MACD is kind of a little bit iffy. I think the MACD is a great tool when you use it as a mechanical trading indicator in conjunction with other moving averages, but utilizing it by itself, it is more descriptive than anything else. And it is really beneficial because it can tell you some amazing things, but I think that's all you should grab from it. And what you should really be looking at the MACD on isn't like I'm trading on these crosses, because yeah, if you backtest it in hindsight, it looks great. Yeah, every time I get this cross, I get this upwards move. You know, every time I get a cross, I get this upwards move. And it looks great in hindsight, but in reality, we see a lot of fake crosses on the MACD where it looks like it's going to cross and then downturns, and you never even see it happen again. So over here, for example, this would have looked like it was going to cross over. All right, if we go back in time, this would have looked like it was going to cross over. Everyone go, oh, we're going to get a MACD cross, we're going to go upwards. And then all of a sudden we have this massive red candle and head downwards, and then the cross disappears. So trading based off crosses is pretty freaking stupid in my opinion. You're probably going to get wrecked. You have to utilize the MACD in conjunction with moving averages. What I like to utilize the MACD for is if I see a lot of like light green, or light red candles in a row, I can see there's a significant decrease in selling pressure and a significant increase in buying pressure over this period. Now, if I identify, you know, a bullish reversal pattern with that, and I have increasing volume at the same time, then I can identify, well, maybe if we get a positive cross, we're going to head upwards, and that would happen. All right. Vice versa, if we have a significant decrease over a period of time in buying volume and increase in selling volume, because remember, dark green means there's more buying than selling, light green means there's more selling increasing in comparison to the buying from the last period. Okay, that's what it means, all right? So there's decrease. It doesn't mean there's more selling volume. If there's more selling volume, it would be red. It doesn't mean that. It just means there's been a decrease in buying in comparison to selling over that last period. So we have this draw or drag down, this draw out of selling pressure and potentially a decrease in price leading after the momentum. So what is it telling us? It's not telling us too much, guys. We've only had 2 on there. I don't like to use on the large time frames anyway. It's not telling us too much. It is telling us that we do have some sort of bottoming out or consolidation happening at the current position. That is what it is telling us. Let's take a look at the RSI. Now, everyone who uses the RSI should be able to identify straight away we have a pretty clear pattern forming here. And this is a very interesting pattern because this is a very bullish pattern, and that is obviously a descending wedge. Okay, we have a descending wedge forming on the RSI right over here. And we had this fake out over here, which was that blow off top fake out. All right, this is our high. This is the all-time high for Bitcoin, not in terms of price, in terms of macro structure. And this is a blow off top. This should never have happened. We can confirm it was actually a fake out from the RSI. We still have our RSI. What does this tell us? It is telling us we are closer to the bottom than we are to the top, obviously, all right? But we're not going to go to freaking $2,000 for Bitcoin. Not going to happen. We might come down 16,500, might come down a little bit lower. Worst case scenario, 12,000, all right? Touch the bottom over here again. One more retest before we head back up. When we break that RSI, we have positive momentum. We have a new bull market. A new bull market rally will occur, okay? Obviously, we need to clear that level here, which will clear this level here for momentum. We're very, very explosive, very, very bullish. We can expect a new all-time high when that breaks. Price points, don't know, don't care, not gonna talk about it. We can expect a new all-time high though. That is about all I want to talk about on the weekly, guys. Let's go down to another chart, and we'll go ahead and utilize this chart over here. Let's just quickly get rid of some of these drawings because we got a lot of them. I like to annotate as we go on the chart. Let me know, do you like the drawing on the chart? I personally I find it helps me think about what I'm saying a little bit. If I annotate with these little circles and stuff when I'm talking about it, I find it really helps. Let's go to a 3-day chart, guys. And the 3-day chart will be where we start including some of those other indicators now. So let's go ahead and talk about, first and foremost, the VPVR. And VPVR, guys, is such a beneficial tool, guys, particularly when you are scalping, when you are trading ranges, or if you're just trading on a macro. I find it's really beneficial because you can identify areas like this, right? Very, very different area. We have area number 1, area number 2, all right? 2 completely different areas, all right? Number 1 represents a period, so number 1 over here represents a period of very, very historical high trading volume. And with trading volume, we have stagnation, we have resistance, we have consolidation, okay? With low trading volume, we have movement, we have momentum, we have velocity, okay? So we have these different characteristics. In low trading volume ranges, we're more likely to see fucking retarded candles like this, okay? Where we just like tank it. Show you again, low trading volume range, massive red candles, all right? And look, if we zoom out, huge green candles. It goes both ways. It goes both ways, all right? So with low trading volume ranges, we see these huge moves. That's when our moves come. That's when the moves come. Higher trading volume ranges, that's when we see these resistance levels, these consolidations, these macro structures forming, just like we had over here, okay? And yes, they update in real time, meaning before we had this would have been a lower trading volume range, but it draws back. It draws back from previous historical trading volume too, if we zoom out over here. But what it is telling us, guys, is if we zoom in, our major resistance is still sitting just above this price action over here. We can see 21,750. Where does that line up with? The dotted trend line, the horizontal resistance. Where are we now? We're coming to the scoop, all right? Coming to the scoop of this valley, all right? What does that mean? It's a reversal point. It means we're at a reversal point. If we do lose it, we have major support here at 19,230. If we lose 19,230, like I said at the start of the video, we will head down to 17,500. There's no historical trading volume here. We will gap it as a wick, as a scam wick, down to 16,500. All right, we would see something like this. All right, that is something like what we would see, okay, if that occurs. Not going to say that's exactly what we're going to see. I'm not going to try to predict that, but that is kind of what we would see, okay? So massive resistance over here, massive support. This whole range here, flooded with resistance. It's going to be very, very unlikely to see the price just spin around here. If anyone's saying, the price is going to do a 180 from right now and just fly back upwards, look, it can happen. I'm not going to say it's not going to happen, but it's very unlikely. If it does happen, that's a statistical anomaly compared to what we think is going to happen, which is a little bit more of a drawdown. Now, I do find there's a possibility that we find a little bit of temporary support here, get a little bit of a bounce. Yes, there's a chance, but it's more likely we just tank it down if this trend line breaks. Back to the short-term time frame. Again, uptrending support line, downtrending resistance. We have that other chart over here which represents we are in a bullish pattern. Again, the highest we can go is about 20,500, and that would line up with this downtrending resistance over here. A move upwards, reject, back down. Possibility, 100%, right? Keep an eye on it. Again, the POC line is sitting here. If we do break out the POC line, we have positive momentum. We have that next resistance here. That's probably the highest we go, okay? I think that's about it today, guys. I don't think I've got anything else more to say. I could probably talk for another 50 minutes about different technical indicators we can use for the charts, but I feel like anything more than I say now, it'll just be exacerbating what I've said. It'll be confirming what I've already told you. I think we've gone through a majority of the stuff I wanted to talk about today, so I think I'm gonna leave it there. Anyway, if you liked the video, consider liking, subscribing, sharing. Obviously, we provide, we aim to provide the most in-depth, realistic, unbiased, and unfiltered technical analysis on the market. Obviously, I've been a TA, I've been a market technician for 7 years now, been trading purely, I'm talking purely off TA. I don't trade news events. I don't trade anything else. I don't trade, fundamental analysis. I don't care about that stuff. I purely trade data and analysis with the charts, obviously macro, micro, whatever you want to talk about, time frames, all that kind of cool stuff. All right. So with that being said, guys, I'll catch you in the next video. Have a good day. Cheers. Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.